It's Greece's big squeeze, $6.6 billion in additional deficit cuts, as we heard today, and the budget belt tightening is calming the currency markets. We saw the euro rising and the pound also snapped out of its longest losing streak against the dollar since 2008. To discuss the situation and more, with me here in the London studio is Derrick, chief currency strategist at a bank of New York Mellon. Good to have you on the show.
Thank you.
Okay, let's talk through those details. Greece faces 20 billion euros in terms of debt redemptions over the course of April and May. Are these additional measures enough to convince investors and go back and buy Greek bonds, which then would finance those redemptions?
Well, the first thing to say is the cuts today were very much in line with what I think the market was expecting. I mean, I think they had a 45 billion euro range of additional austerity measures.
Right.
Priced in effect. So I don't think the market's going to be overly upset by what they've seen today. The question is, do you as a investor want to actually add to your Greek debt holdings at the moment? And I think that this is really coming down to this question of what is the rest of the European Union going to do to help encourage that buying? Now, there was some talk over the weekend that perhaps some of the governments would, via state banks, provide guarantees for some of that buying. We've yet to see any details of that. The German finance ministry is still saying no bailouts. Until we get details of that, we really don't know. My guess is we will find out details relatively quickly, because if not, Greece has already said if there is no support coming from the EU, they'll go elsewhere.
Exactly. That would be the IMF. The Prime Minister himself told his cabinet and told the press that they might be looking at the IMF if the EU is not forthcoming. And very interesting, you mentioned the mood in Germany. There's a survey done by the Financial Times in Germany that the German banks are not inclined to take on more Greek government debt. That pretty much captures the mood.
I think that, and that's exactly right. I think this is why it's so important that if they are going to buy any more, there has to be German government guarantees. What worries me is if you provide those guarantees, what that means for sovereign debt elsewhere in Europe. For
example, in Germany, AAA rating, absolutely pristine.
Precisely.
Up to now.
Yeah, or alternatively, even Portuguese debt. For example, if I'm provided a guarantee for holding German sovereign debt, Greek sovereign debt, I might be prepared to buy some more, but I may decide in return to reduce my holdings of leverage or debt from Southern Europe elsewhere. I think overall it's a bit of a deck of cards. Things can start to move through relatively quickly. My real concern, though, is if Germany starts providing guarantees for a variety of different nations' debt, as you said, what does this mean for German sovereign debt? And if that's the case, what does that mean for the euro? Because one of the things we've based our buying of euros on over the course of the last decade is really the probity of German fiscal policy. And suddenly are we taking that away? And if that's the case, is the euro quite the currency we always thought it was?
Let's look to tomorrow. ECB, obviously, they will be quizzed about what's going on in Greece. Very briefly, what is the most contentious issue tomorrow? You expect the euro to move on?
I think it will be Greece more than anything else, and I think they will be trying to find out rather more. The reporters there will be trying to find out rather more whether there really is a package, what the EU Commission thinks about it, what the ECB actually thinks about the package today. I would guess that Mr. Trichet is going to say as little as he possibly can.
That will be very difficult, knowing those journalists. Thank you so much, Derrick, a bank of New York Mellon.